Why should companies raise investment? Actually, there are two types of new companies, one of which should always raise investment and one of which should never raise investment. If you're an entrepreneur starting a new company or have recently started a new company, you should think hard at the beginning, what type of company do you want to start? Do you want to create a startup or do you want to create SME or small medium enterprise? The difference between startup and SME can be a little confusing because both are small. All companies start small. The difference is startup companies start small, but they are designed by the entrepreneur to grow big fast. SMEs also start small, but they are designed by the entrepreneur to grow slowly, profitably over long periods of time. Both of these choices are equally valid for the individual entrepreneur. So there's no right or wrong choice. Do I want to create a startup? Do I want to create an SME? But you should be clear in your mind when you create the company, or as soon as possible, what is your aspiration for this business? Is it to create a high growth startup, which I call a scalable business, or is it to create a SME, which I call a lifestyle business? Startup, scalable business, SME, lifestyle business. There are very important consequences that flow from this decision that will affect many other choices that you, the entrepreneur, will need to make over the lifetime of this company. The fundamental difference between startup and SME or scalable and lifestyle business, in addition to the growth rate and the growth trajectory, is the distribution of the economic fruits of the business. So a startup is designed to grow large quickly or grow quickly over a relatively short period of time. And as it does that, it is designed to generate a payout for the shareholders, including the founders, over a relatively longer period of time. An SME or lifestyle business is designed to generate a paycheck for the founders as quickly as possible. So we can look at this difference as payout versus paycheck, where the scalable startup will be designed to generate a long-term payout and the SME or lifestyle business will be designed to generate a paycheck. So if I'm an entrepreneur who is starting a business because I want to be my own boss and because I want to earn as quickly as possible as much as I would earn working for somebody else in a large company given my skill set and market value, then you should think SME and think lifestyle business, because this type of business is designed to, as you can guess from the name, effectively fund the lifestyle of the entrepreneur. And that's a great thing to do. But you can never raise money for that type of business. You shouldn't try to raise money for that type of business. If you want to create an SME or lifestyle business, then you should fund that business with your own money or with short-term or business loan from the bank or credit card debt, or however makes most sense for you to get the business up and running, get it profitable quickly, and then pay back loan if you need to take a loan, and then keep as much of the profit as you can for as long as you can. If you are going to do a startup, meaning a high growth scalable business, then you definitely need to raise money, because that business, startup scalable business, is designed to grow big fast. What enables a business to grow big fast is capital, meaning funding. Now, if you think about a car, what enables a car to drive fast, or what enables a car to drive long distance? It's fuel, the fuel that drives the car. It's either gasoline or now maybe electricity. But if you have not enough fuel in the car is not going to drive as fast, or it's not going to drive as long of a distance. It's the same thing with your company. what does it mean to grow a company? To grow a company, you can grow the revenue, you can grow the number of customers, you can grow the number of products, you can grow the number of markets, you can grow the number of employees. One, some, or all of those will lead to a growing company or constitute a growing company. But none of those things come for free. Every one of those dimensions along which you might grow the business require money to grow. And the more money that your business has to fund that growth, the faster the potential growth. Now, don't confuse that to mean if you only have more money, you will definitely grow faster. I hear a lot of entrepreneurs make that mistake. Just having more money doesn't mean that you will grow faster, because you may invest that money in the business in such a way that you don't maximize growth. But it is fair to say that given more money and having that money invested properly in growing the business, your business will grow faster than it would have grown with less money or with no money. So high growth startup, you need to raise money. SME, there's no point to raise money. The mistake that I see entrepreneurs make is one, on the one hand, they might try to raise money for their lifestyle business, which doesn't make sense because the growth trajectory of that business will never be fast enough and increase the company value enough over a reasonable investment time frame for that investment to make sense for venture investors. Other mistake, the entrepreneur who wants to scale their business believes or tries to do it without raising money. Now, is it possible to do that? Yes, it's possible to do that. And I know that we can come up with a few examples of startups that successfully scaled without raising money. But that is the exception rather than the rule. The vast majority of startups that successfully scale raise money and raise large amounts of money if they're going to scale very big. You could be the exception case that is able to scale successfully without raising money, but it is hard enough to create a successful scalable startup even with funding. To do that without funding, it's almost guaranteed to fail. So why are entrepreneurs sometimes, or maybe often at the beginning, hesitant to raise money to grow their business? Because this means if they're going to use equity funding, which is the most common form of funding for high growth startup, they're going to have to share the ownership of the business and ultimately the economic fruits of that business with investors. But that's okay, because why? The way that I like to put it to entrepreneurs considering whether to fund their business with external equity or fund the business themselves, you can have a small piece of a big pie, or you can have a big piece of a small pie, but you won't have a big piece of a big pie. There are no big pieces of big pies. When you get external funding for your business, you can grow it very big. You will have to give up ownership in that business through equity investment in order to get that big, but your share of that business will be worth much more than your 100% share of your unfunded SME almost every time. So think about that. Do you want a big piece of a small pie or a small piece of a much bigger pie? And make sure that you fund the business according to your decision.